Tom Lee just did a massive flip. He went full bear mode. He thinks the next 8 weeks in the market are going to be a complete crap show. I'm going to play an interview right now showing exactly what he just said, his massive flip. Then I'm going to break down the entire interview and show you a huge trade that I think I can make $100,000 on. You can still get in this trade right now if you want to. I think it's going to absolutely skyrocket. Here's the interview.
I think investors should be cautious for the next 8 weeks. September.
Next 8 weeks, be cautious.
Yes.
You're not always cautious.
That's right. Market's been up 7 of the 8 months this year, so we know it's an incredibly strong market. But we also have the September cuts, and we have the election, things that'll get people nervous. I think in the next 8 weeks, people get a chance to buy. So I think it's good to be cautious, but just ready to buy that dip.
And all along, Tom, when you've made these prescient calls, some of them even short term, it had to do with positive surprises on inflation. And is that going to be enough from here on out to keep the market headed higher, or have we shifted to growth worries now?
I think there's probably more growth worries in people's minds these days. So the jobs reports and claims seem to have more market reaction. I think that's going to be the case in September as well. I mean, we have the Fed meeting sort of in the middle of the month. But this week is the jobs report. I'm sure there's going to be a lot of focus on that.
Right. So what kept you positive was that the numbers were always, for the market, they were better than people were thinking. Is that going to continue to be the case? But it's no longer inflation. It's now growth. So growth will continue pretty good. Jobs will continue pretty good. You're not worried about another growth scare like we had 6 weeks ago?
Yes. I think that the growth scare is what everyone's worried about, because the July jobs report was kind of a shock to markets, and that's part of how we had that Tokyo Black Monday. I think this jobs report for August is going to show a nice rebound for growth in jobs. Hopefully it's not too strong, because, of course, as you know, if it's too strong, people are going to worry the Fed might backpedal on a September cut.
Some uncertainty and caution going into the election, but in your view, people should get long.
I think they'll get a chance to buy long, yeah. So I think this is one of those where investors need to be cautious, but in the back of their minds, no, this is a strong market.
How far down, Tom? 10%?
I think that 7 to 10 is a possibility. And we've already had 2 7% corrections this year. So it's been testing investors' patience. But I think we should expect turbulence.
And then the question, of course, is when the turbulence comes, is it a buy the dip always?
I think,
or is there going to be and by the way, buy the dip at when it goes down by 2 or 3%, or you really actually have to wait for a 5, 6, 7% pullback?
I think 1 or 2 is just almost like daily noise. This market has shown, pullbacks like that. So I think something like a 5% pullback is very likely, but I think we do.
And are you waiting for that?
Yeah, I think it. You know what? We'll find out this jobs report, because if it's too strong and investors worry, and so the stock market's down Friday, I would be buying that dip. But there's a chance that we get a good jobs report and the market's up. I hate to sound so binary, but I would just say at the bottom line is it's a strong market. So I don't think we've seen the top for 2024. It's just that the next 8 weeks are tougher.
I mean, Tom sounds pretty bearish right now. Usually all of his interviews, he's super bullish. He's like a permabull, honestly. He's saying it's a summer of small caps. Stocks are going to keep going up. He thinks we're going to see more all-time highs this year. He just said he expects a 10% drop in the next 8 weeks. So if Tom thinks the stocks are going to fall about 10% in the next 8 weeks, that's going to put Triple Q down by roughly $50 a share. So we're going to be around $410 a share. Now remember, my average strike price on all the Triple Q puts that I sold is roughly $370. So I am totally fine to get assigned shares of Triple Q for $370. This is why I always stress you only want to sell puts on something you're okay to hold for the long run. Because if I get assigned shares of Triple Q at $370 a share, I will sit on those shares and I will sell covered calls until I get rid of those shares. That is my strategy. But if you sell puts on something that's garbage and it falls and it never recovers, you're screwed. But I believe in Triple Q for the long run, so that's why I sell puts on the Qs. Now, if IWM falls 10%, it's going to be sub $200. So you guys know that I had calls and I sold puts on IWM, and there's some information actually that just came out that I realized on IWM. So this is their website, the iShares website, the official website. So it says right here, the price to earnings ratio is a fundamental measure used to determine if an investment is valued appropriately. Each holding P ratio is the latest closing price divided by the latest fiscal year's earnings per share. Negative P ratios are excluded from this calculation. So this is the main thing that I'm concerned about right here. Negative P ratios are excluded from the P ratio on IWM, so that's the Russell. The problem is that roughly half of the IWM index is not profitable. So right now it's the middle of the night when I'm recording this video, the P ratio right now says 0.00, but when I went on the website earlier today, it said the P ratio going forward was like 15. So the problem with the P ratio of 15 is that's only taking the top 50% of the index. Because remember, negative P ratios are not included into this formula, and 50% of the Russell 2000 index is not profitable. And it's actually impossible to calculate a P ratio on something with a negative number, because P ratio is price divided by earnings. So if you do price divided by a negative number, it's impossible to divide by a negative number, so you can't calculate it. So it's hard to value the Russell 2000 because there's no legit P ratio out there. If I had to make a wild guess if there was a way to factor it all in, I think the P ratio is somewhere around like 50. So it very well is possible that the IWM index is actually overvalued right now. So what I did was the calls that I have out there, I closed out. I still have the puts that I sold on IWM. And this is why I recommend everyone go to Discord, because when I make trades in real time, you could see that in there. So this all plays into what Tom Lee just said. Tom is saying that there's recession fears, there's growth fears, there's fears that the Federal Reserve has kept interest rates too high for too long. When rates are too high for too long, that really hurts the economy, and there's a chance that rates have been too high for too long.
What do you know about inflation that the market doesn't seem to understand right now? You don't think we need to be as hawkish as we are?
Yes. A lot of it has to do with why CPI has remained stubbornly high. Powell talked about it, that there's this residual lag associated with housing. So even though home prices are stabilizing and rents are actually getting back to sort of traditional rates of growth, it's still reported in CPI at close to 6%. And then the second piece is auto insurance, is what Powell calls non-housing services. Auto insurance is rising at 21%. Now, a lot of that's because auto insurance rates are actually jumping, but that's not going to keep going 20% forever. Once that starts to normalize, then you can think about what median inflation is, which is running at 1.8%. So I think inflation's going to sort of cool pretty dramatically. I don't know when, but it'll be sometime in the second half of this year.
So Tom Lee is saying that inflation is actually a lot lower than what is being reported at right now, because a lot of the data that goes into the inflation reports is laggy. So I think this has big implications for the stock that I'm going to show you in just a minute, because I'm in the camp that rates are going to fall and inflation is actually a lot lower than what it's being reported at. And if that's the case, I think the bond prices are going to go up, because bond prices and bond yields move inverse of each other. So if yields go down, bond prices go up. So Tom mentioned a jobs report that's going to come out soon. He's saying that if the jobs report is strong, meaning there's a lot of new jobs created, that's going to put pressure on the Fed to not cut as much as we're expecting. But if the jobs report is weak, that gives the Fed the green light to cut maybe even 50 basis points at the next meeting. So he is expecting a lot of volatility in the next 8 weeks. Now, I think there's a certain part of the market that you could actually make a lot of money on this. It seems like a setup that's probably a win-win whether the market goes up or down. I think it's going to play out pretty good. So I'm going to go into that trade right now. So I have to show you this chart real quick, because everything on this trade is going to be based off of this. So this is a chart of the federal funds interest rates for 2015 till currently. So when we did this raising cycle from 2016 to like 2019, they raised interest rates from essentially 0 to 2.4%, and then they cut to 0. So they did an interest rate cut of a total of 2.4%. So this right here is a CME Fed Watch tool. So currently our interest rates right now are 5.5%. So if we go to September 17th of 2025, you can see the rates are expected to be somewhere around 3.25% from 5.5. So that's a 2.25% interest rate cut, kind of similar to what happened right here. So we're going to look at what this means. So January of 2019, this is when the Federal Reserve first indicated that they were going to start cutting rates. It doesn't matter when they actually cut, it matters when they signal that they're going to cut. So January of 2019, they signaled they were going to cut. Now we're going to look at a price of the stock that I think is an absolute moon when we get interest rate cuts. So January of 2019, remember that date. So this right here, the ticker is TMF. So TMF tracks the prices of bonds. So if interest rates go down, the price of bonds will go up because they move inverse of each other. So right here, remember that date, January of 2019. So January of 2019, TMF was roughly $200 per share. Roughly 1 year later, remember that's when the Federal Reserve went from signaling that they were going to cut to 1 year later. The price of TMF was $472. So roughly 1 year later, remember from when the Fed signaled that they were going to cut till roughly 1 year later, that's what this is right here. TMF went from $200 a share to $472. It did more than a double. So if we're expecting a similar 2.25% interest rate cut in the next year, we would expect this chart to be somewhere down here, and then we would expect a similar move on the TMF. So right now TMF is $60 a share. If it does a similar move as the previous rate cut cycle, this will be somewhere around $150 a share. So this is my portfolio right here. You know, there's a lot of volatility in the market right now. So we're at 764,000 right now. We're up 3,600 bucks today, up 480,000 in 2 years. So we're gonna look at the exact trade that I made. So right here, you can see the trade that I made on TMF. So I bought 10 call contracts right here at a strike price of 58 bucks a share, and it goes till January 17th of 2025. So right now I'm up like 750 bucks on this trade. It's roughly flat. So the question is it too late to get into this trade? I think the answer is definitely no. Reason being is I think the market's roughly 6 months forward looking. So if the market looks forward roughly 6 months, it's pricing in roughly 75 basis points of cuts, but there's a whole 2.25% of interest rate cuts are expected to come in about a year from now. So when December of this year rolls around, the market's going to be looking forward to like July of next year. So when the market's looking towards July of next year, I think at that point is when the full value of this trade is going to be realized. Because you got to understand, the Fed's probably not going to cut rates to zero. They signaled somewhere around 2 to 3% is the neutral rate. So if July of next year, they're signaling that they're going to be at 3%, they're right around the neutral rate. So when that happens and that gets fully priced in, I think that's going to happen sometime around December of this year. So I plan to hold on to these calls until December of this year. I'm in the camp that interest rates are going to fall, inflation's going to fall. I think the economy is more likely to weaken than strengthen, so it's also going to put pressure on the Federal Reserve to cut interest rates. And remember, when they cut rates, interest rates go down, bond yields go down, but bond prices go up. If you want to learn how I trade stock options, I made a really good video. I put the link for that in the description below. Also, my Discord channel is super helpful. Right after the market closes, I usually go on there and talk for about 10 minutes to give everyone an update of all the positions I have open, all the potential trades that we're going to be making, all the insights that you need. It's all in Discord. Links for that below. Check it out. And if you made it this far, like, subscribe. I'll see you guys later.